Hi there, 𝘄𝗲𝗽, Lauren Hall here from Loan Market Edge, coming to you with our weekly wrap after a little bit of time away. We're excited to get back in touch and get back into the groove of sharing the good news as the good news brokers, what is trending in lending. So, our new financial year. Yep. Wow, back to the bottom of the greasy pole in our world. Wipe the board clean, here we go again. It's been a massive year. Big congratulations to our very own Lauren Hall for making Elite this year, which is good. So thanks. In the top, I think it's 8 to 10% of brokers in the state, well, in the country. So that's really exciting, and was fortunate to make Platinum Elite myself as well. So big shout out to our amazing team. So it's very much a team effort to get us, help get us both there. So very exciting to hit those milestones for us within our group, industry or within our group after what's been still a fairly challenging or pretty disruptive year. So very excited to share that news and kick off into the new year. One thing is really topical at the moment. What's trending in lending, you ask? So is the servicing buffers. We talk a lot with clients about this. So I guess what does that mean? So since May 21, maybe I should have double checked that date, but I'm pretty sure. Well, Loz said this before, but roughly sort of 2 years ago, as rates were starting to move downwards at the pace they were, the bank had increased their buffer, or the government forced the banks to increase their buffer, servicing buffer, from 2.5 to 3%. So whatever the interest rate was that you were receiving over this period, the last set of 2 years, they have a buffer of 3% on top of that, I guess, as a bit of a stress test. Responsible lending, totally on board with it, especially when rates are at 1, 2 and 3%. Where that's probably been a little bit challenging of late is we've, 12 rate increases in the last 13 months means that suddenly that buffer is now sitting on top of a 5 or 6%. So clients are being serviced at 8 or 9%. So their sort of barrier to entry somewhat when it comes to their serviceability or how much they can borrow, in a lot of cases is probably down 35 to 40%. So it's reduced significantly over this period. And there's sort of two... We're letting Lauren talk a little bit more, apparently.
You took a breath, so I was like, I'm in. And there's two main types of clients that are affected by that. There's clients that are looking to refinance, obviously, because rates have come up, maybe have come out of a fixed rate and are looking to move banks and are now seeing that assessment buffer on top of the rate is proving challenging to be able to move, even though you show you can afford a higher repayment. And then also on the other side, if you're looking to get into the market or buy more property, again, understanding that borrowing capacity is now different. So really two types of clients or affected by that.
And even more tricky if you have a portfolio of lending and you have more than one loan, they're adding that buffer across your portfolio. So they're not just doing it to your new lending, they're going, we're actually going to make the other 3 loans that you have over the term remaining, which might be, say, 20 years, if you took it out 10 years ago, take the rate, load another 3% on top of that, and take maybe 80% of the rental income. So there's a huge disconnect, I guess, when you would look at it and go, well, I can easily afford this, versus the way that they've been calculating that. So the good news, as the good news brokers, some lenders of recent have sort of, in particular, really started to lean into being able to help or assist existing clients with their existing loans that are sort of, say, stuck on, or we talk about the mortgage handcuffs, where they effectively, like you said, they can prove they can actually afford more, but they just don't qualify under these new rules. And they're stuck on a higher rate from a bank that effectively, is not prepared to discount to them as a new bank would. So with this, a heap of them, well, there's only really 2 or 3 now. I say a heap. It feels like a heap because it's just good to have bloody one at least. So have come out and actually reduced the buffer that you need to service by, which would normally be 3%. They've reduce that down to 1% buffer. Yeah, so not for new lending. Again, there's still going to be some really strict requirements and rules around lending with new clients, but if you're an existing client, and some of the notes we had for qualifying there, if you've been meeting your requirements, if that shows on that loan is on your credit file and also shows that you've been meeting your requirements on there, meeting your repayments on there, it's sub 80%. A large 2 of the 3 are PAYG only. So there's a couple of qualifiers, and effectively it's no increase to the loan. So it's just basically saying we've got a loan over here of 600,000. You know, it's stuck on a 7% interest rate. We want to take it over here to a bank. No increase in lending. Take the 600 over, but get at a rate. A rate at the moment is probably 1% cheaper. Like there's significant discounts with these lenders as well. They're really doing all they can to assist in this position, and the borrowing capacity for those clients. Then they don't have to meet the crazy 3% buffer on that board. It's literally down to 1%. So that's a significant change, and we're finding, you know, for a lot of clients that effectively were failing servicing or weren't meeting those requirements, we're now able to sort of get that back across the desk, rerun the numbers, and effectively it can be as easy as long as you're meeting the repayments. It's dollar for dollar. We can refinance you across. And
it's really, there's not a lot of sometimes common sense used in this game, but it's a real common sense approach from the banks to go, well, hang on a minute. They're showing they can meet the commitment. The risk is lower. Rather than needing them to service on that higher buffer, we can take them on as a client, save them some money, which is what it's about. And that can sometimes make the difference between you keeping your home and selling it. You know, that difference in interest with all the costs going up. So it's I don't think I've ever seen it. I don't know if you have. You've been kicking around quite a lot longer than me. But, you know, it's great to see that, to go, hey, we actually do want to help, and we're prepared to take on new clients that are good clients and show that they can afford this commitment and save them some money. So,
so it's sort of, so, you know, if that's you, obviously, or you know anyone that's had problems trying to refinance in the last couple of years, it absolutely, we know why, and it's not uncommon, and you're not alone, but please reach out. Let's get it in touch. Let's have a look at that. As long as that mortgage is in good shape, there's every chance we can move that across to a better lender. And look, hopefully it feels like it's here to stay. You know, it's sort of, I'm very confident that they're pushing this at the rate they are, to go, this is here to stay. So get in touch and let's make that, where possible, our goal is to try and help as many clients as possible in this period. Just at least review it, take advantage of it. So that's probably the big one for this week. Short and sharp. Now, a little bit different. We did do a little bit of a call out on the socials, but if you guys have anything particular topics wise that you want us to talk about, this has been one that was really topical for us, but by all means, if there's anything you'd like us to break down, me do the jokes on, Loz maybe not talk as much, you know, is there anything you want us to cover off, do shout out. You can either comment on below the video or shoot us a DM or an email, and we'd love to, you know, share that knowledge. So for now, have a great weekend, and we will talk to you guys soon.
Bye.
Bye.